So this morning we are fortunate enough. Tawny Patrick is with us from Seven Gables. She's gonna. Well, I guess you don't really have to play the part of the millennial because you are the millennial.
It's an easy part to play.
Easy part to play, right? So, and you've got the experience in real estate from both the home ownership side and the investor side.
Yeah.
And we're going to go through and look at. We get a monthly market report from our friends over at Keeping Current Matters. And because it's called a monthly market report, they send it to us every month. And we're going to go through the report or part of it. We never get through all of it. And just give our own impressions on it. Some of the areas we might talk about, some we might not. Some of them I might even ask Josh to throw the slide up. And I think he's got it ready there just in case. But the first one, on a quarterly basis, home prices rose as seasonally adjusted 1% in the first quarter. The fact that prices rose slightly in the first quarter is evidence of significant pent-up mortgage demand despite ongoing affordability constraints. And that's according to Doug Duncan, Senior Vice President, Chief Economist at Fannie Mae. Do you think people are really care about the mortgage rates, or is it driving anything to happen?
I think they do because it drastically affects people's affordability.
Okay.
So the people some people were waiting just because they, on principle, didn't want to pay high interest rates. But some people, they were just priced out because of the high interest rates.
Now, what is high?
Oh, and that's a good question.
Because when is that one from the millennial
for millennials, I mean, when I graduated college and bought my first home, I think they were about 4%.
4%.
And I remember people telling me like, oh, that's a really good interest rate. But I had no context beyond that year,
Sure.
That was when I was first starting out. And I was like, oh, 4%, like that sounds good to me. And so when it jumped up to 6-7%, like I had never seen that before. So that felt super high to me.
Right. Okay. So now we're still now we're at, in the mid sixes. So does the millennial generation say, okay, I can't buy then? Or is everyone thinking it's going to go back down to the 2s and 3s?
I think people, especially millennials, I don't think they understood how much the interest rates affected their payment.
Oh, okay.
So I think they quickly realized that the higher interest rate was going to give them a drastically higher payment. And I do think a lot of them believe it's going to come down in the 2 and 3s again, but they don't know that this was like historic. That had never happened before.
Right. That's a key thing right there. So you start looking at it and saying, okay, well, that's what I'm going to wait for that. And you might be waiting an awful long time.
Yeah.
So, and so have any of them started saying, well, I can't afford where I want to be now because of the interest rates?
Some are looking to move outside of the state.
Okay.
Some are just trying to save up more. Some are waiting for the interest rates to fall.
Just a mix.
It's a mix, yeah.
Okay. Yeah, because the old people like me, we look at it. I bought my first house. You're going to laugh. 18%.
That's painful.
Yeah, and you probably know the area. It was right below the Orange County Mining Company.
Nice.
Right out of college. I know. You might have been born then. But, we were able to go to the mining company and walk down the hill or stumble down the hill right into our backyard. But 18%.
Yeah.
That's
I hope we never see that again.
So do I. Something but it goes both ways. So the idea 18% is not good because the economy wasn't good.
Yeah.
And 2 or 3% wasn't good because the economy wasn't good.
Yeah. It really messed us up I think it's going to mess us up for a while.
Yeah. A lot of people are spoiled. And then you look at the values. So we talk about that slide that values went up. And okay, so we're looking at 3 sources here. Case-Shiller is showing that we pretty much peaked, or the declines hit their maximum in August. Case-Shiller, FHFA, and CoreLogic I like FHFA. Do you follow these 3?
A little bit.
Okay. So I like FHFA just because, it's not skewed as much, right? It's only the conforming loan amounts. So the other ones, you get cash buyers in there and you can get skewed by the high-priced homes, which, you're along the coastal area, so you get a lot of the higher price stuff.
Yeah.
So, but FHFA, really the loan values have really only dropped 0.6% in July and 0.7% in August. Other than that, they've been pretty flat or up.
Yeah.
So now the question becomes, do you hear many people saying, okay, well, I'm going to wait for home prices to come down too?
They're still saying that. Yeah, and I'm trying to show them that data, like, yeah, the past couple of months, like, they've actually been going back up. So I mean, it's possible that they could go down further. I mean,
Sure.
nothing's impossible, but from the data that we have, it doesn't look like we're gonna see those sustained decreases.
Yeah, not a whole lot of impetus for them going down.
Yeah.
And well, maybe some of them listen to Diana Olick on CNBC, and the next time she gets something right, it'll be the first time. So she's still telling people that she's trying to say, well, it's because of mortgage rates. She doesn't realize that there's economics 101, supply and demand.
Yeah, it's
Right?
huge.
In the areas that you're working mostly, do you see a lot of supply?
No, man, there's nothing for people to look at.
Yeah, it's pretty tough. 5 months ago, prices were declining on a seasonally adjusted month-over-month basis in 92% of all major U.S. markets. Fast forward to March, and the situation has done a little 180, with prices now rising in 92% of markets from February. That's according to Andy Walden, VP Enterprise Research at Black Knight. So prices are not declining in most markets.
No, and even when my clients were submitting offers on things are going for 100,000 over asking. One of them went for 200,000 over asking.
Was it because they were priced low strategically, or there was just so many people wanting that property?
There was. I mean, some of them were like on the. It wasn't that they were priced low, but they were the only house in that price range.
Okay.
So it was like there was 40 people trying to get that house, and they kept overbidding it over and over.
Were they financed, or did you ever find out were they financed or were they cash?
A lot of them were cash.
Yeah.
Not all of them, but there were definitely some cash contenders.
I was consulting with an agent last week about a couple properties in Newport Beach, and they said they had multiple offers on each of them. And the agents and the homeowners basically said, we're not going to consider anything unless it's a cash offer.
Yeah.
That's tough.
Yeah.
Right.
It's like we're back to where we were like a year or two ago.
Yeah. And that's the problem. Tawny Patrick is with us from Seven Gables Real Estate. I guess I should have the whole right name in there. It's Sack and
Stone
Team at Seven Gables Real Estate.
Yep.
Got to get it right. I'm a little slow. Okay, so we're going to go back and continue with our report here. Major change in Fannie Mae's changing their mind. So we were talking in the last segment, if you missed it, sorry. But we were talking in the last segment about real estate value declines. And in March, Fannie Mae said that real estate values for 2023 were going to drop by 4.2%. None of us really believed them. April, they're saying now 1.2% drop. Do you think that's going to happen, or do you think it's that we're going to see them going up? Where's your crystal ball?
From what we've seen, at least in our area, it seems like they're going up.
Seems like most areas. I know that there's a couple of our research sources are saying that we may see a slight decline for the year. But I can't imagine where that's going to come from, because we've got no supply of properties.
Yeah.
People are still getting older. People are still having babies. They're still wanting to get out of mom and dad's basement. They're still getting divorced. They're still going into, there's a few defaults, not a lot.
Yeah.
And we're going into a recession.
Yeah.
So the issue here is, I don't know what the catalyst is going to be for properties to drop when there's nothing available.
People are saying that they're going to die in their home because they don't want to give up their 2-3% interest rate.
Why would you?
Yeah.
Right. I mean, so we have to wait for them to die. I'm not going to even go there. Inventory and foreclosure updates. Months inventory of homes for sale. Wow. I'm just looking at this chart, and we've got the chart here from both during the Great Recession, which is probably your only recession.
Yeah, really.
Okay. And what's going on today. And, it was a buyer's market in 2010. Right now, we haven't seen a buyer's market since maybe 2012, maybe.
Yeah.
Right. Nothing. I mean, and mainly because of supply.
Yeah. I wonder if they're going to have to shift the metrics, though, for what is that? Just, I mean, with the amount of inventory it is, it's like, I don't know if we're ever going to see those levels of inventory again.
Might be tough.
Yeah.
Or it might be a long time from now, just because of some of the people that have those sub 4%, which most people right now have sub 4%. the only reason they might want to move is just because it's too much property,
Yeah.
right? If you've got somebody that was, got into that sub 4 and, they wanted a 4-bedroom, 5-bedroom house. They wanted a house with an office, and now they're in their golden years, maybe it's too much house for them.
Yeah. Or, a bachelor that bought a,
Studio
or 1-bedroom condo out of college, and it's like now he's got a family and needs to buy something bigger.
Could be. Yeah, that's for sure. Adam data, U.S. foreclosure activity continues to climb in the first quarter of 2023. Does anybody believe that? These are the headlines that are out there that people are seeing.
I know. I was just talking to people about this the other day because they're talking about, there's going to be all these foreclosures coming on the market. But then when you look at the graph of how it compares to back in, 2009, 2010, it's like, okay, for perspective.
Right. So I get from our friends, I guess I'm not supposed to say this, but I'm going to. Because great resources for people like you and myself are data that we can get from title companies.
Oh, yeah.
Right. So I asked one of my friends at a title company, and I'm not going to mention name because I don't want to get them in trouble, about the notice of defaults and notice of trustee sales. And I ask it on an irregular basis. I got the numbers in February for Orange County. The total number of defaults was 499.
Okay.
For the entire county.
Wow.
And April 25th, I asked, because we've got a lot more defaults coming on the market, is what everyone's telling us, right?
Mm-hmm.
So we're up to a whopping 544. It's not a lot for the whole
Which
county.
is technically increased.
Yeah,
but
it's up 10%.
Yeah, I mean, which sounds like, that's a big number, but
Right.
when you look at the actual numbers, that's not that much.
Well, I did look, and something, because that's one of the problems that we see with some of the folks that we get data from, and the consumer gets data from. And the problem is they get it from people like Diana Olick at CNBC, and they give them such bad data.
Mm-hmm.
So I looked a couple of weeks ago from our friends at Altos Research, and they track every home for sale every week. And the amount of homes available for sale in Anaheim Hills 92807, it increased by 5% in 1 week. Went from 21 to 22.
Yeah.
Right. So there's still no inventory, and it only went up 1, but by mathematics, that was 5% increase.
Yeah. Well, back when the months of inventory were like 2 weeks, and then the months of inventory doubled.
Right.
It's like, well, now it's 4 weeks.
Yeah,
Great.
Exactly. So there's still nothing available.
Yeah.
And that's the point when I look at this. So on April 28th, there was 21 homes available for sale, and May 12th, there's 21 homes available for sale.
Yeah.
Right. So there's no change. There's still nothing available to buy. So regardless of what you want to think about these things, there's no inventory. Yeah. So these headlines, be careful of headlines, is I guess the bottom point here. U.S. foreclosure filings jumped 22%. So there's the headline from MSN, right? So in Orange County, we were up 10%.
Yeah.
Still nothing though. So don't be fooled by some of these headlines is the bottom line here. Over 1 million fewer foreclosures in the last 3 years.
Yeah.
Right. So think about that as that's where the whole numbers come from. And, so they are up, but 2020 and 2021, I wonder why there was so few foreclosures.
Yeah. No one had to foreclose.
It was a pandemic. They weren't allowed to.
Yeah.
Right. I mean, maybe private, if you had private loans, you could foreclose.
Yeah.
But a Fannie Mae, Freddie Mac, USDA, FHA, VA, not allowed to foreclose.
Yeah. I'm really surprised there aren't more than
Really?
what we're saying. Well, because it was so long that people couldn't foreclose. You'd think that all that over the years that they weren't.
But if you think about it, in 2020 and 2021, we had 20% appreciation each year?
Yeah, that's true.
So
I guess they didn't really need to. They could always just sell.
Well, either they had their heads stuck in the sand.
Yeah.
Or they could call you and you could sell their property and at least get them out whole, or with a little bit of it, save some of their equity, right?
Yeah.
So now those that bought in 2022, they may have a little bit more of a challenge.
Yeah.
Right? Because we didn't see a huge appreciation in 2022.
Mm-hmm.
And if you bought on a minimum down payment, if you bought with an FHA loan, $1,079,000, I think it is in some areas, right?
Yeah.
So you buy with an FHA loan, you're upside down. And if you're going through that death, default, divorce, lost your job,
mm-hmm.
you might need to sell, and those might be available for short sale,
Yeah.
right? So
But are they going to make a huge difference in the prices? Probably not.
no, they're not going to make a huge difference in the pricing, and there's not a lot of them because we didn't have a lot of sales last year,
Yeah.
right? So property with foreclosure filings, again, going from over 900,000 of them in 2010 and under 100,000
Yeah, we're
now.
under 100,000 right now. It's a huge difference.
So the question becomes, how do you get that information to the millennial? Got to do a TikTok video or something.
Yeah, I actually just filmed a video on this.
Did you?
Yeah.
Now, okay, what platform did you put it on?
I'm actually probably gonna be posting it on Instagram today.
Instagram. Okay.
Yeah, on Reels. I'll probably put it on TikTok too. I do both.
Okay. So how do we find you on those?
You know what? My names are different on either one. I gotta fix that.
Oh, that makes it. Are you incognito or a secret agent or what?
No, well, I think I'm like Tawny OC Realtor, and I think the other one I'm like Tawny the Realtor or something.
Okay.
I gotta fix that.
I was gonna say that makes it kind of difficult to find you.
Yeah.
Okay, so watch for Tawny the OC Realtor or Tawny the Realtor, one or the other, somewhere. But the point is you were on Instagram Reels, and I don't even understand that one, and TikTok, which I understand a little bit.
Yeah, I'm definitely no like social media whiz. I'm learning.
No, but the point is though, that's where the millennials are going to find their information.
Yeah, no, absolutely.
Right? I mean, you're not putting it on the back page of the register.
Yeah.
I don't even know there is a back page on the register. I'm not sure there's a front page of the register anymore.
Yeah.
Right? So you've got to go to some sort of social media to reach the millennial.
Yeah.
Okay. U.S. foreclosure activity continues to climb in the first quarter of 2023. There were 95,712 U.S. properties with foreclosure filings. During the first quarter of 23, a total of 65,000 U.S. properties started foreclosure. One in every one. So I don't know if you remember this because obviously you're the millennial. One in every 1,459 housing units had a foreclosure filing in the first quarter. I think that we were under like one in every 4.
Oh, wow. Yeah. That's
during the Great Recession.
Yeah.
Right. It was, I mean, you could look one way or the other on your block and you knew somebody.
Yeah.
Or you didn't know them. You could, like guys like us, we could find it. No one was out there putting a flag out in front of their house saying, I'm in foreclosure.
Yeah. And that recession was caused by the real estate market too.
Right.
Like this is a completely different scenario.
So speak about that a little bit, because that's a huge point. So real estate did not drop because of the recession, right?
Back in 2008.
Right? The recession happened because of real estate.
Yeah.
Right. So it's a big difference. So when we look and say, okay, well, real estate values dropped by 19.7% because in that recession, well, it was the recession causing it.
Yeah.
Right now, real estate will probably help us out of the recession because we might be able to get more houses on the market. And every time there's a house sold, think about how much economic activity comes from that.
Oh, yeah.
Right. I mean, I had heard one time there was like 1.7 was the factor. So if you had $100,000 house, there was $170,000 in economic activity because of that.
That's
between, the cost of title insurance and everybody that gets paid from that, and the cost of moving, right?
Yeah.
Trucks and
think about all the vendors we have, construction people,
right.
Like so many different people.
Think about all that. Obviously the lenders get paid, and the underwriters get paid, and the loan processors get paid, and the bankers get paid, and the realtors get paid, and the transaction coordinators, and so it's a huge amount of economic activity comes from all this. So the bottom line there is if we get more houses coming onto the market, they're going to be absorbed because people want them.
Yeah.
And we're going to talk, if you think the real estate values are going to drop because of the recession, we're going to talk about that. And if you think interest rates are going to drop because of the recession, we're going to talk about that. I know that we've got some data on that coming up. There's no reason to panic, at least not yet. Foreclosure filings began ticking up in late 2021 after the federal foreclosure moratorium ended, government intervention. The moratorium was enacted in the early days of COVID-19 when millions of Americans lost their jobs to prevent a tsunami of homeowners losing their jobs, according to Claire Trapasso, executive news editor of Realtor.com. Okay, that makes sense, right? So nobody was getting foreclosed upon because you couldn't. We talked about that a little bit. A mild recession starting later this year with a recovery over the subsequent 2 years. Do millennials see that there's a recession coming? Do you hear that from your
Yeah, I do hear it a lot, and it's probably mostly from like the news sources and media that, everyone's always talking about a recession.
Is there a fear of it?
There is. It's interesting because when my generation thinks of a recession, they think about 2008.
Okay.
That's our biggest
Sure.
recession that we've gone through, so that's what they think about. But at the time, a lot of millennials also weren't, they were just kind of going into the job market. So it was really hard to find work. So I think they're also worried that, if they are looking for a job, like it's going to be getting a lot harder to be finding work.
That's a whole new perspective that we haven't talked about.
Mm-hmm.
So the millennials have that job fear.
Yes.
Okay. Now, so I've got 3 millennial kids, and tells you how old I am. Okay, I get it. So are millennials getting more realistic about income? I know my oldest son thought that he was going to start out with a mid 6-figure job as the CEO of every company.
Really? I don't feel like I had that perspective. I was like, I think my first job out of college, I think I made like $38,000.
Okay.
And I was like, wow, this is great.
Okay. Well, so you were more realistic.
I think I was. And I mean, I guess the people I was around, I didn't really see that perspective from the people that I was with, that they had this unrealistic expectation.
Okay. So your peer group was a little more realistic there.
Yeah, I think so.
Okay. That's good. So that there's not as big a, because my son's finally coming back to realization that, there's not every company is a Fortune 500 company looking to hire him as a 30-year-old or 30, 32, 33, whatever he is.
Yeah.
And pay him a mid 6-figure job.
I think Gen Z is a little bit more unrealistic than we were, but I'm sure there was some of that with millennials as well.
Okay. So Fed meeting summary, March 2023, given their assessment of the potential economic effects of the recent banking sector developments, the staff's projection at the time of the March meeting included a mild recession starting later this year, with surprise, with a recovery over the subsequent 2 years. So that's coming out of the Fed as well. Does the banking developments, do you hear anybody talking about that in the millennial world?
Yeah, I think just the fear of banks failing, because that's we heard about that before, but I don't think that millennials really remember what happened. They just know that's bad.
It's bad. Okay. Yeah. Which makes sense.
Yeah.
It's did you remember something called the implodometer?
Implodometer? I don't think so.
Okay. So in the 2008 recession, there was something called the implodometer. And we were looking every day at this, and it was listing all the banks that failed that day, which there was 511 of them.
Wow.
So, we were all watching that to say, okay, who's next?
Yeah.
Especially being in the mortgage world at that time, because a bank that you worked for might be going out of business, right? Or one of the investors or lenders or something along those lines. So just another part of it. How would housing be impacted by a recession? So when we come back, Tawny Patrick, Sack and Stone team at Seven Gables Real Estate, is our guest. She's the millennial. You can tell who the old man is. That's pretty obvious here. So we're having a discussion here on what's going on in this real estate world. And we like to get the 2 perspectives every month. We get a lot of data from our friends over at Keeping Current Matters. Question: how would housing be impacted by a recession? Bank rate: during a traditional recession, the Fed will usually lower interest rates. They say they're not going to, but they will. This creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunity for home buyers. Pros and cons of buying during a recession. Pros are less competition, lower prices, lower rates. Cons: stricter lending requirements, fewer options available, economic uncertainty. Is that going to stop anybody?
I mean, it'll stop people who lose their job, I guess.
That might be a challenging one.
Yeah. But most people, they see the word recession and they think, oh, the economy is doing bad, so that means house prices will go down. But that's not what actually happens most of the time.
So talk about that a little bit, being that we've got a slide right here for it.
Yeah, we've got a slide. These are the last 6 recessions that we've gone through. And you can see out of the last 6 recessions, only 2 of them have caused home prices to go down. And of those, one of them is 2008. The other one, it only went down a little over 1%.
Yeah, so if you think that the recession is going to make it easier on the price side, it's not going to have an effect.
Yeah, most likely what usually happens is prices go up because
Right.
they drop the interest rates down, so they become more affordable, and people who are still employed and still have the cash and want a good investment are ready to swoop in, and they're buying the houses.
So you hit a big item right there, because one of the problems that we've had over the last year is affordability.
Yeah.
Right, and we're basically, I don't even know if we'll get to the slide on it, but affordability right now is probably the worst it's been since probably right before the Great Recession. Three things go into affordability. So you've got income is one, you've got property values is the second, and interest rates is a third.
Yeah.
Right. So affordability we're seeing that those people that have jobs, their wages are still going up. So
but they just haven't gone up enough with inflation and all that either.
Absolutely. So that's a big issue.
Yeah.
What is the conversation in the millennial world about inflation?
Everything's more expensive, from the grocery store to gas to childcare. It just feels like we're being squeezed on all sides.
I don't even know if you know this answer, but is there a major change in the price of childcare?
It's outrageous.
Really?
Yeah. You can easily spend per child it's probably going to be over $1,000 a month.
Wow.
Yeah.
That's a lot of money.
It's a lot of money.
And we've seen that car payments are now up to on average $800 a month. Childcare is $1,000, and wow, that's a lot. So, does that go into people's thought process of whether to have kids or not?
I think it does. A lot of people, especially Gen Zers, you're seeing more and more that they're not even planning on having kids.
Wow. So that's a problem in a lot of ways.
It's going to be a big problem in the future.
Yeah.
I don't think we're going to have to worry about overpopulation in the future.
Yeah, that might. So recession means falling mortgage rates. So every one of the last 6 recessions, interest rates have come down. 1981, 5%.
That's a lot. That's a big one.
Although
if it was at 18% to begin with, then
yeah, so went all the way down to 13.
Yeah.
So that was still, but so we're heading into a recession. Most everyone is on the same page with that.
Yeah.
Right. So property values will probably go up. Interest rates will go down. That'll mean affordability will be better. So that'll be good. If you still have a job, you're in good shape. And if you don't have a job or you can't document it, be aware there's something out there called creative financing. A lot of people don't understand that, but there is still creative financing out there. And if you don't understand it, give us a call, 800-306-1990. Unfortunately, I'm old enough that we had to get creative in the 80s.
Oh, yeah.
Right? When you're, really when you think about it, so I bought my first house, and I think it was 83 or 84, somewhere in that range. So there were still houses on the market that were coming on that were from the 70s that had that 7 and 8% interest rate. We're going into 18%. You say, well, how do you afford that? Creative financing.
Yeah.
Right? So right now, when we look at the chart right here, if my math is correct, that's 64% or 65% of the homes are under 4% interest rate. Next slide there, Josh. I think it's slide 22. But what's that? Isn't that 60, 62, 63, something along those lines? Over 60%.
Yeah.
Under 4%. It's gonna take some catalyst to get somebody out of that property.
Oh, yeah.
Now, I just heard one the other day, though. She wants to move to Florida. Right? So just a thought right there. There's and then people have equity.
Yeah.
Still a huge amount of so I know you've talked about it on radio before that you bought up, right? You kept your old one bought up, or did you just buy rental properties?
I bought. So yes, we bought we have our own house and a rental property.
Was the rental property bought as a rental? Or
It was
did you-
bought as a rental.
Okay, so
Yeah.
so the question then becomes is, have you considered moving up from where you are now?
Yeah. Well, yeah, in the future, because we've got a 3% interest rate on our current house. If we want to move into something bigger, I'm going to do everything I can to keep that property as a rental property.
Sure, because it'll probably cash flow for you.
Yeah.
Why not? So Americans sitting on tremendous equity, 67.6% have paid off mortgage or have at least 50% equity.
Yeah.
That's a beautiful thought right there, right?
So a lot of those people, they're going to be able to rent out their house and buy something else.
Which then doesn't help us at all with the idea.
Nope, with no inventory.
No inventory. Okay, so I think we've learned some new stuff here today. I hope you've got some benefits from this. Property values are not going to drop. We don't foresee that. Mortgage rates will. Affordability is going to get better. And if you have a reason to sell, call Tawny. Does that wrap it up?
Yeah, that sounds good.
There we go. So if you want more information on this or anything we talk about, give me a call, 800-306-1999.